3 weeks without getting stopped out. Not 3 trades, 3 weeks, 21 days of trading, 42 setups, and not a single stop hit. And before you think I'm just waiting for perfect setups or trading with massive stops, I'm risking the same 1% per trade I always have. Same position sizes, same markets. But something fundamental changed in how I think about stop losses in 2026, and once you understand this method, getting randomly stopped out becomes a choice, not an inevitability. Most traders are getting absolutely destroyed by stop hunts right now, and they don't even realize they're doing it to themselves. Every time you get stopped out by 3 or 4 pips and watch the trade rocket in your direction 10 minutes later, that's not the market being unfair. That's you placing your stop exactly where the algorithms are programmed to look. You're waving a flag saying, "Here's my money, come take it." And in 2026, the market is faster, more algorithmic, and more ruthless about hunting retail stops than it's ever been. What's actually happening behind the scenes is simple but brutal. The algorithms can see order flow. They can see where retail stops are clustered. They know that most traders put their stops 5 to 10 pips below obvious support, 5 to 10 pips above obvious resistance, or just outside the most recent candle. That's where nearly everyone is taught to put them. So institutions deliberately push price into those zones to trigger stops before the real move begins. It's not manipulation, it's liquidity. They're flushing out weak hands, and if your stop is placed in those obvious areas, you become a weak hand, even if your market read is correct. The traders who stay in winning trades while everyone else gets stopped out and complains online aren't predicting the market better. They aren't smarter. They aren't using tighter stops or wider stops. They're using a completely different framework for where stops belong. That's the framework I'm about to show you. And it's not theory. It's the exact repeatable process that's kept me in trades that stopped out the majority of retail traders within the first few minutes. This isn't about better analysis. It's about placing your risk where the market cannot reach you unless your idea is objectively wrong. The shift starts with understanding what a stop loss actually is. A stop loss is not there to protect you from losing money. That belief alone causes most execution mistakes. A stop loss is a filter. Its job is to filter out trades that do not have enough structural room to develop naturally within your risk tolerance. Once you truly understand that, the way you approach every setup changes. Most traders operate in reverse. They see a setup, they focus on the entry, they imagine the profit, and then they look at how much they're willing to lose. The stop becomes something they force into place after the fact. It turns into a compromise between excitement and fear instead of something dictated by structure. They'll see a breakout where the true invalidation point is 20 or 30 pips away, realize they can only afford 10, and slide the stop closer while hoping price doesn't wick the extra distance. That hope is expensive, and it's the reason so many traders keep getting stopped out of trades that eventually work. The correct framework is much simpler, but far more disciplined. When you see a setup, before you think about entries or targets, you ask one question: where does this trade become structurally invalid? Not uncomfortable, not scary, invalid. That level is non-negotiable. If price reaches that point, the idea is wrong. That's where the stop belongs, and if that distance exceeds your risk tolerance, you do not adjust the stop. You reject the trade. Let's look at how this plays out in real time. Imagine price has been compressing in a tight range for a prolonged period, roughly a 25 to 30 pip box. The highs are capped, the lows are supported, and volatility is contracting. Then price breaks out with momentum, strong candles, increased participation. Everything about it looks like a textbook breakout. The old approach tells you to put your stop just below the breakout candle, maybe 5 or 8 pips away, somewhere that feels safe. What actually happens most of the time is very different. Price breaks out by a few pips, pauses, and then pulls back. That pullback is normal. Institutions take partial profits, late traders attempt fades, and the market needs liquidity to continue. Price dips 10 to 15 pips back toward the prior range. Your stop gets tagged by a wick and you're out. Minutes later, price expands 30, 40, even 50 pips in the original direction. You feel hunted, targeted, and unlucky, but nothing unfair happened. You placed your stop exactly where liquidity was engineered. Now apply the structural framework. A breakout does not fail because price retests the breakout level. A breakout fails only if price re-enters the entire consolidation structure. That means the stop belongs beyond the opposite side of the range, typically 5 to 10 pips beyond the full structure to account for volatility. Instead of risking 8 pips, you're now risking 30 or 40, and this is where most traders sabotage themselves. They see the larger pip distance and panic. They convince themselves price shouldn't come back that far, so they compromise. They split the difference and place the stop somewhere in the middle, which has no structural meaning and still sits inside the liquidity zone. Then they get stopped out anyway. The correct response when the structural stop exceeds your risk tolerance is simple. You don't take the trade. Forcing a trade with an insufficient stop guarantees you'll get stopped out even when you're right, and being right but losing is more psychologically damaging than being wrong. To make this clear, imagine two traders seeing the same setup. The first trader allows a fixed dollar risk that translates to roughly 15 pips. The structural stop requires closer to 35. He doesn't want to miss the move, convinces himself it's strong enough, and places the stop 15 pips away. Price pulls back 20 pips, his stop is hit, and then price runs hard. He loses money on a correct idea and walks away frustrated, blaming the market. The second trader sees the same setup and identifies the same 35 pip invalidation point. He calculates the risk and sees that it doesn't fit. He doesn't negotiate with the stop or force the trade. He simply passes. He watches the pullback, the stop cascade, and the expansion without emotional involvement. Later in the session, another setup appears with a tighter structure. This time, the invalidation point is around 12 pips, and his risk allows it. He takes the trade, stays in during the pullback because his stop is beyond structure, not inside noise, and the trade reaches target cleanly. Same market, same day, completely different outcomes. Over time, this difference compounds dramatically. The trader who forces trades takes more positions, experiences more stop-outs, and slowly burns out. The trader who filters trades takes fewer positions, but each one is structurally sound. His win rate improves, his average win increases, and his stress disappears. The framework itself is straightforward. First, you identify structural invalidation and ignore candles and entries entirely. You focus only on where the setup objectively breaks. Support trades invalidate below the entire support zone, not the candle you entered on. Breakouts invalidate beyond the full consolidation range. Trend pullbacks invalidate beyond the swing that defines the trend, not the pullback trigger. That level is your stop. Next, you check whether the pick distance actually fits your risk, and this is where discipline either shows up or collapses. You measure the number of pips from your intended entry to the structural invalidation point. Not roughly, not emotionally, but precisely. You then convert that pip distance into dollars based on your position size and your predefined risk per trade. At that moment, there is no interpretation involved. The number either fits your rules or it doesn't. If it fits, you proceed without hesitation. If it doesn't, you have only two valid responses. You reduce position size so the dollar risk aligns with your rules, or you skip the trade entirely. What you never do under any circumstances is move the stop closer just to make the numbers feel better. The stop is dictated by structure, not by your comfort level, and the moment you compromise that, you've already accepted a probabilistic loss, even if the trade eventually moves in your direction. Finally, once the stop is placed, you trust it completely. This is a critical psychological shift. That stop was set when you were calm, objective, and thinking in terms of structure rather than emotion. You don't touch it because price is hovering nearby. You don't tighten it because you want to reduce risk. You don't move it because a candle looks threatening. The only time a stop is adjusted is when the market itself creates new structure that objectively justifies a change, such as a new higher low in an uptrend, or a confirmed structural shift that allows you to trail risk forward. Even then, the stop moves because the market earned it, not because you got nervous. If you find yourself wanting to touch the stop for emotional reasons, that's not a market signal. That's information about your own lack of alignment with the trade. This approach will dramatically reduce how often you trade, and that reduction is not a side effect, it's the point. If you're currently taking 15 or 20 trades a week, expect that number to drop to 5 or even fewer. In the beginning, this feels deeply uncomfortable. Your brain will tell you that you're missing opportunities, that you're being too selective, that you're not doing enough. You'll watch trades move without you and feel the urge to jump in late or force the next setup. That discomfort is the filter working exactly as intended. Over time, something important shifts. When you do get stopped out, it actually makes sense. The structure truly broke. The market invalidated the idea. Instead of frustration and confusion, the stop provides clarity. It tells you the trade was wrong, not that you were unlucky. When you apply this consistently across common setups, the rules become very clear. Support and resistance are not single lines, but pip-based zones formed by repeated reactions, and stops belong beyond the entire zone with an added buffer for volatility. Breakout trades require stops beyond the full pre-break consolidation range, no matter how wide that range is or how badly you want to be in the move. Trend trades require stops beyond the structural swing that defines a trend itself, not the candle or micro pullback you happen to enter on. If following these rules forces you to trade smaller size than you're used to, you accept that without negotiation. Position size follows structure. It does not follow ego, excitement, or impatience. Here's the truth most traders avoid because it's uncomfortable. If you are getting stopped out on more than 40% of your trades, Your stop placement is broken. Not your analysis, not your strategy, not your market read. Your stops. You are placing them in areas where liquidity is deliberately engineered and repeatedly accessed. The traders who eventually break out of this cycle don't do it by blaming the market or hunting for a new indicator. They slow down. They wait. They filter aggressively. They align structure with risk. And most importantly, they give their trades enough room to actually work instead of suffocating them at the first sign of noise. That's how you stop getting stopped out in 2026. Not by predicting the market better, not by tightening stops, and not by blindly widening them either, but by using structural stops placed only where the trade is objectively invalid, and by only taking trades where those stops fit cleanly within your risk framework. Everything else is noise, distraction, or self-sabotage. 3 weeks without a stop hit didn't come from avoiding risk or playing it safe. It came from only taking risk when structure genuinely supported it, and from refusing to force trades that didn't fit. That's the method. That's the edge. And that's how you stay in winning trades while everyone else gets shaken out and convinces themselves the market is rigged.